On the back of that listing, of course, the day two numbers seem to suggest around 0.8 times in terms of subscription. But I won't ask you on that. I will ask you on the fact that the retail interest in this IPO has been lower than what one would have anticipated. You believe that there is some mismatch with regard to understanding valuations of ICICI Pru, and do you believe you've left enough money on the table for the retail investor?
See, if I step back, we can get into the valuations, but if I step back, the industry has been doing quite well. If you see the last 7 years of the industry, forget last 2 years, which look very abnormally high when you talk about growth of 30% plus, etc., etc. But if you look at the last 7 years, 18% has been the growth in the top line. Almost 20 of the industry. I'm not talking about the company, which numbers might be better, but the industry itself is growing well, both on the top line as well as the bottom line. When an industry is growing on the top line and bottom line at this in teens or high teens, and there is no net worth required, you don't require capital to build this business. So we don't require capital to grow the business further. So when this kind of industries normally command a higher PE ratios, right? We are also in the business of valuation. So we understand that. So if you look at peers also, peers are valued very high. And one of the very important thing to understand, and which communication has to be better from our side, this business goes on operating profit, right? What is your operating profit? The total profit more than the PAT. The operating profit after tax is more important, because what is the revenue or what are the profits you are generating out of the business, right? Other income is a factor of how much net worth you have kept in the business. If you keep more net worth, you tend to have higher other income. No point in multiplying the other income by 40. Otherwise, a 10,000 rupees net worth, you will value it at 24,000 crores. Right, 10,000 crores net worth, you will value at 24,000 crores if you multiply the PAT by the 40 PE ratio or something like that. So this is an industry which does not require capital, but at the same time has got growth. So if you look at industries which do not require capital and have growth and have a very high dividend payout, these are the kind of numbers that one sees for peers also. And it has been, we believe that we have kept sufficient, because we have got an operating profit market share of around 20% in the industry, and which is one of the best in the industries. So operating profit, if you look at all the numbers with operating profit in mind, it looks.
But that number is sustainable, sir. I know forward-looking is tough, but you believe sustainability there?
I believe that this is a good business,
sure,
where the growth rate of the top line, India is all about volumes. India is not about margins. I think the regulator has done a brilliant job of ensuring that our margins are reasonable or low.
Sure.
Lower the margin, better the business in India, because India is a place where you have to play volumes and not margins, especially asset management. If you charge more to the customer experience won't be. Why do we get money? Why does a customer invest with us? Only when his past experience is good, then he increases his investment. There is no other way of getting money except ensuring that that the customer is satisfied with the return that he is getting.
That's true.
You can have the best sales and distribution in the country, but if your customer experience is not good, you will not get the money, right? So what SEBI has ensured with the very good regulations is that the margins in India, in the industry, would be restricted. And we have always seen lower the margin, more the profitability, because it's a volume business. People tend lower the margin, better the customer experience, bigger the funds, it's good for business. So I'm not talking theory, I'm talking what we have experienced as an AMC. Absolutely. You know my funds which were 10,000 crores and 20,000 crores, because they started charging less and gave better customer experience, today they are sitting at 75,000 crores. ICICI Prudential Multi-Asset Fund, what was it some 2 years back? Right, it was in say 15-20,000 crores, and today it is at around 75,000 crores. Why it has happened? Because customer experience is good. It is charging less. ICICI Prudential Large Cap, ICICI Prudential Multi Cap Fund. This is our experience. So lower margins do not hassle us.
Nimesh, you got some of the marquee names in the pre-IPO and in the anchor book, which is there. From a retail point of view, the price point, I'm not talking about the valuation here, the price point seems to be much higher, right? 2,165 at the upper end of the price band, and one lot he gets only 6 shares. Do you think that is also a optical point?
So that is more of a retail sentiment.
Yeah, but I'm talking from a retail point of view actually.
Yeah, so but there is no solution to it. I can't give a fraction of a share, right? I have to give one share, right? So whatever could have been done in that sphere, we have done, right? We understand that part. But now I think we want the customer to understand and come. So it's okay. I know from a sentiment point of view, it may look high, but it is only a sentiment. Finance can't be on. So this is what we could have done. And I think it will be accepted eventually by the customer.
There's one more thing which is striking actually when insurance companies come in, and I think in LIC's case, and you can correct me, the policy holders had a quota, but in mutual funds case, the unit holder doesn't have a quota in the IPO. Do you think that's something which the regulator should look at it?
See, we in our business, the regulator has done absolutely brilliant. I have been in this place since 2007 and I have seen lots of changes happening. And I think while a lot of people would have views on that, I believe that the regulator has absolutely done a brilliant job of regulating this industry well. And that is why this industry is growing. So I don't think, I leave it to the regulator. I have to run my business within the regulations given in the country. And as per the regulations, you can't do it now. There would be some issues. I don't know what.
Incrementally, if you see on a monthly basis, the net flows into equity funds has gone up there. And you talk about some of the funds which have been good recipients of it, and you get a good market share of that new fund flows that comes in. Do you see this flow sustaining in your assessment? Because you have a much better view of when you go out and speak to the investors or unit holders. And a lot of flows are now coming beyond 30 cities as well. So how do you see that expansion and growth for your funds as well?
See, what has happened when you go out of the country. I would have done some 100 roadshows in the last 3 months. There was not a single meeting in which SIP flows were not discussed. Whether it is US or Europe or Southeast Asia, the one thing that is always discussed is SIP flows. People are amazed by the sustainability of the SIP flows. 14 months, the returns from the equity markets have not been there. But SIP flows are sustaining. So when I talk to people also, I said, I can't see the future. I'm not supposed to discuss the future and I will not discuss the future. But see, SIP is a way of life for Indians, whether it was earlier also happening in the banks. Recurring deposits always used to be there in the banks. SIP actually feeds into how Indians save. Right? Even in 25 years back, when my son was 6 months old, my wife was very, very keen. Where is the money for my son's education? He was 6 months old, and she wanted me to put every month I said, I'm a good investor. See, look at my Excel sheet, or in those times, Lotus 123 sheet. It is a good sheet. I have allocated it well. She didn't want all that. She wanted a policy or a scheme, child education scheme. Right? That's how a retail mind thinks. She wanted that fund that every month you put in. So SIP is nothing a manifestation of what my wife was thinking 25 years back, that when he is 18, he should have that much money. So a lot of distributors are doing this monthly installments of SIP. Right? They only focus on goal-based SIPs. That there should be a goal against every SIP and then it becomes sustainable. SIPs which are goal-based will work well. SIPs which are gone on 1 year performance, have come through some online channel directly, not guided by anybody, and have seen last 1 year's performance and come in, those guys will be disappointed. So as I started the conversation, if the customer experience is good, those SIP are sustainable. If the customer experience is not good, those SIPs are not sustainable. They will close.
But just building on to that, just building on to that, talking about SIFs or the new passive funds that have come, and that is seeing a lot of retail interest as well. Is that cannibalizing your active equity AUM at all?
Two separate issues, SIF and passive.
Yeah.
Right?
So
I'll
the new
discuss
ones
them
that are
separately.
seeing
So SIF
interest.
is a great innovation that SEBI has come up with. It is too early days for equity investors because now we'll launch the schemes. In the next 6 months, we'll see ICICI launching our SIFs. Over a period of time, we'll see the performance of those. Customers will also see the performance of those, and after 2-3 years, they'll start building on that. See, typically how a product happens, you come with the NFO. After 3 years, people see the performance and then they put money into that. Right? So SIF also goes in the same way. So equity investors should not get very excited about that because that is a 3-year plus story. Come to
Passive funds.
passives. As long as active performs, passive is that much many years away. Right now, we have shown performance. I'm saying it's a very simple thing. Right now, if you see the when you look at the ETFs, 90% of the ETF flows is actually institutional in nature. Only 10% retail in nature. And if you see the year 24-25 where data is out, if 100 rupees has come in active, 6.25 rupees has come in passive. So as long as active perform, then active will do well. If I am giving more return than passive, you will invest with me. If passive is giving more return than active, you will not call me to the studio also. You will buy an ETF fund, right? So we are there only till we give a performance, right? So 90% of my funds are beating benchmark, right? Over a 3-year basis, 90% of my funds are beating benchmark. So then 90% of this one, I have done my dharma is to beat benchmark. As long as I beat benchmark, money will come to us and not go to passive. If we don't beat benchmark, we don't deserve the money. Money should go to passives. So I think both these things are different.
How do you look at innovation in fund house? Means you have funds there, you are into various other categories, but diversification of risk is also there, right? Means if the market go on a downside, then you need to have other vehicles as well. So what is the strategy that you have from a fund house of how do you distribute your profitability in equally across various vehicles?
Actually, you have asked me my favorite question. As they say in cricket, you have given me a half volley outside the off stump. Right? So, what we pride ourselves on, that we have managed scale well. As we have grown in size, still our customers are happy with us because our performance continues. How have we achieved that? By what you said just now. Right? We have got products which have been given to different people having different styles of fund management. So we have got a fund manager who focuses on value and contra styles, right? But no fund management style in this company is more than 35%. So we divide our assets amongst various fund managers with different style, and this is not today. We have grown only because of this. Today we are 6,50,000 crores of equity, but even when we are 50,000 crores, we had made presentation to our distributors that the assets were divided into 3 different styles, right? Today I've got 15 fund managers, right? So we spread our assets into various people and various products and people. So there is a value style, value and contra style, who also takes concentrated exposure. Then there is a growth style, there is a quality style. So each fund, the product and the fund manager style are married together so that the investor gets the best deal. The product performs the way we have stipulated within the boundaries of the stipulation of the product controls, as well as we don't compromise the fund manager style. So it is very important to manage style and product, and I believe you can manage scale. I have seen a lot of American AMC's model that they manage trillions of dollars and still their performance does not get affected. They keep on dividing the assets into various parts. And that is the way you can manage scale at the same time have performance.
Okay, and on that note, we'll have to slip into a time-bound commercial, but we'll keep this conversation going on the other side of this break. So Mr. Shah will be with us in the studio. We'll be right back after this very short break.